Hi, this is Merrill, a tax tutor. In this video, we're going to talk about estimated payments and how those work. So over the years, I've had a number of clients that had to make estimated payments. So we always work with them and advise them on how those work. So first off, when are estimated payments due? There are 4 due dates. They are due in a typical year, April 15th, then June 15th, September 15th. Let me fix that a little bit here. September 15th, and then January 15th. So we've got those 4 due dates throughout the year. So you can see that the first estimated payment is due April 15th, which also happens to be the date that any taxes due on your tax return is due as well. So people could have a double tax payment that day if they haven't paid in everything that they need to for the prior year. They'll have to pay that on April 15th, and then they're going to have to start paying the future year or that current year that they're in on April 15th as well. And then it spreads it out over June, September, and then January 15th. So the way that you calculate those estimated payments are all dependent upon how much income you're reported on a return to start with. So if you are single or married filing separately and you make more than $75,000, or if you're married filing jointly making more than $150,000, then you have what's called the 110% rule. If you're below those numbers, it's just 100%, but above those numbers are the 110% rule. So what exactly does that mean? Well, it means if your income is going up from one year to the next, you need to pay in at least 110% of your prior year tax to be covered, to be safe. So let's say you file a return in 1 year, and the tax due on that return is $10,000. Okay, and it's not the tax that you have to pay. You have to look at the tax liability line. So on your return, there's all these lines. So what we're looking at is the total tax that is assessed on your tax return before you get into all the payments that you've made and everything. What is that total tax number? So let's say that number is $10,000. and your income is over, let's say you're married and your income's over $150,000, in that case, you're going to have to pay in 110% of that prior year tax to be safe, to be penalty proof. So if your tax was $10,000, you'd have to pay in $11,000 over the coming year. And the way that you do that is you take that $11,000, you divide that by 4, and then those payments are now due April 15th, June 15th, September 15th, and January 15th. Now, if any of those 15ths fall on a weekend, which they oftentimes do, then it gets pushed to the next business day. So if it's on a Saturday, then you look at the Monday. That's when you need to have it in and paid, and that's how it works. Now you say, well, what about a situation where your income is going down? Well, in that case, you just have to pay in 90% of what that tax is going to be due. So let's say you're going from $20,000 of tax due down to $10,000 of tax due, and you don't want to have to pay in all that $20,000 because your income's down, your taxes are down, and everything else. Well, then if your tax due on that return is going to be $10,000, then you're going to want to make sure to have paid in $9,000 for that tax. And again, you take that $9,000 divided by 4, and you'd want to make those payments equally over those 4 periods. An example of this. So I had a client, he was a CEO of a large company. The company went public. He got the stock options and all sorts of things, made a lot of money. So his income went in 1 year was $1 million. The next year went to $40 million. And then the next year it went all the way back down to $1 million. I know, tough guy, the poor guy, right? You feel bad for him, I'm sure. So what did we do in that case? Well, here he owed $1 million in 1 year. Tax on that, we'll say, was $350,000 that he owed on that. The next year he goes to $40 million of income. The tax on that was $15 million. So the safe harbor is we looked at his prior return. His prior return showed that he owed tax of $350,000. We have to take 110% of that. So 10% of $350,000 is $35,000. 350 plus 35, we're at $385,000. Divide that by 4, and that was the payments that he made, and he was penalty proof. Even though he owed $15 million on his tax return, he was penalty proof because we had paid in 110% of his prior year tax. He was fine, he was safe. Then we go into the next year. And the next year, his income drops all the way from $40 million back down to the $1 million. So what's his liability going to be that year? Well, it's going to be back down to $350,000. If we looked at the prior year where he made $40 million and paid $15 million in tax, is he going to pay $15 million in estimated payments that year when he's only making $1 million? No, that's crazy. That doesn't work. So we dropped him back down. We said, okay, you're going to make $350,000, or you're going to make $1 million this year. Your tax on that's going to be $350,000. Take that $350,000, take 90% of that, and as long as he's paid in that 90% of that $350,000, then he's penalty proof. He's safe. In that case, we'd probably make sure you paid in at least that tax that was going to be due or something along those lines, just to be really safe in case something went wrong. But as long as he had that 90% in there, that would be safe. Now, when you are self-employed, when you are making, and you're paying self-employment tax and income tax, those are all due together. When you make an estimated tax payment, you are making that estimated tax payment based on your income tax as well as your self-employment tax, because both of those get assessed on your tax return together and go together on that return. Now, there are some penalties if you don't make these estimated payments. And when we say penalty, it's really the IRS charging interest on it, because the IRS says, hey, you had that money, we don't have the money, we're going to charge you interest. And that rate fluctuates. It goes up and down depending on the interest rate that the IRS is charging at the time. I've seen it fluctuate anywhere between 3% and 6%. It could go higher. That's just historically what it's been the past 20 years. It's been between that 3 and 6%. And the way that it works is that you should have made a payment in April, right? And then the actual taxes due the following April. So you get charged a full 3% on a payment that should have been paid in April, but you end up paying when the taxes due a year later in April. But then this June payment, it actually is prorated, right? So you don't get the full 3%. It's the 3% is annualized. So if you were to take 3% over a year, well, there'd be about 1/4% or something. So you get charged the interest, 1/4% per month. So you get charged the interest between June and April is what you get charged on that June payment. So you really only get, April, you get 10 months of interest charged on that. And then the September 15th to April 15th, you just get a few months there. And then the January to April, you get 4 months of interest there. So it kind of reduces down the closer you get to that payment time. So hopefully that's helpful to go through those estimated payments and show you how those work, how to calculate them, how to take care of clients where their income is going up and down. And we look forward to seeing you in our future videos.